take a step back. Okay, what do I have? I have exposure to 5 major stock sectors, creating one exposure that is like very well rounded. And so what can I do? Like, oh, well, I can, if I'm long, I can sell calls in, IWM, or I can sell calls in SPY, other well-rounded stock market indices there. Or I can say, hey, energy is outperforming. I can go to XLE and sell a call there and maybe get a better value. Yeah, that creativity really does open up when you're going across derivatives and across products. It's really quite fun. Today, not harping on the creative aspect, more just the practical aspect. And before getting to the ETF that we're using for options on our 30-year yield position, Mikey, just want to talk about how short calls on a long position can reduce your cost basis and thus increase your trade duration. So what you're doing, if you bought 30-year yields at about $22 in the futures, or 2.2% in June, and you immediately sold a call against that position, then you probably got maybe, 50, 60 cents for that. And you worked your long, theoretically, down from $22 to like 22 and a half, or closer to 21 there. And thus my break even is lower, my cost basis is lower, and the amount of time I can stay in that trade is thus longer, because I'm not seeing as big P&L swings as if the market went from 22 down to 21. Well, I'm kind of long from 21. Whereas if I didn't put the call on there, Mikey, I'm already out $100, and maybe that was my out metric, and I have to take this thing off, and already I'm out of this trade before I even got to see it bounce. And you could do that in June, and then now we're in July. You can roll that call out to August and on down the line until that market gets to where you want it. It's a lot of great merits that you get, Mikey, by adding a short option onto your long or short position.
Absolutely. I think the covered call is one of the most underrated strategies for a core position there. Reducing your cost basis is one of the actionable, in control techniques we can use as traders to reduce our volatility, to increase that probability of profit. And if you're an investor and you're holding for the long term and you like a core position, I don't think there's an issue in selling an out of the money call option to reduce that cost base and just keep holding. If it gets called away from you, you just add another long position to your core portfolio. I think it's a really unique strategy that affords a whole ton of benefits and isn't too complex to manage or trade out of, et cetera. A lot of cool points there.
Well, it's simple. And what a lot of people will say, especially newbies to trading, will be like, oh, well, that stinks. Like, why would I get rid of all the upside? Like, that's not sexy. That's too conservative. I want this thing to rip in my favor. And what I'll say is, what is sexier than buying a market, selling options against it, and rolling them out. And then at some point, theoretically, you could own that market for free. And I've seen this with several different people email in, or they talk about online on social media and everywhere else. It's like, over the last year, I've been selling calls against my long, shares of this stock, or my long futures in yields. This is actually like one of the more apt markets where you could, over time, get your cost basis so low that you own yields from zero because they're so historically low. And it's really, of course, it's cool to like buy Tesla at $100 and it goes up to 900. But guess what? Now it's come crashing back to a more normal price there. And of course, you would have wished you were selling calls up there at $800, $900. Anyways, that is cool. That is a very sexy trade, to buy something and not to find the risk and have the thing just take off. But I would contend that what is even cooler is selling calls against a long position for a year or whatever time period, rolling them out, that market being at, $10, $20, $30, and be like, oh yeah, I own that thing from zero. Like that. Yeah. That's the coolest thing you could, you have no risk in the trade moving forward. That's awesome, man.
Yeah. One of our colleagues, affectionately known as Dr. Data, is like the granddaddy of this strategy. Like I think he does it with commodities, and he also
silver.
Does it
He's a huge stocks. Silver dude. Yeah.
And he owns it all from so cheap. It's impressive. And I guess, if you're short a market, you can do the opposite if you necessarily wanted to. But even beyond a long-term core investment here, adding options onto any directional position in futures is a neat improvement on just the core strategy of buying or selling a futures contract.
Yeah, especially like I say with these yield products that just in the last few months woke up off of close to 0%. And even after having woken up, they've now kind of come back to close to 0%. And it's like, man, like if you told me that through this strategy, I could in the next several months own the 30-year yield, a market that's traditionally at, 3, 4, 5%, I could own that from 0%. That's pretty freaking cool, man. Like the only risk in that trade is if the Fed does something they've never done historically and goes negative with these rates. And so a really cool thing, how do we get it done? We're going to add options on these yield products as soon as we can. Trust me, we're not just sitting on it and being like, oh, let's do it like next year. It's like we're getting this done as soon as we can from the exchange. Until then, we actually have a pretty great one-for-one trade here in TBT. Now, the correlation is there, Mikey. And what's really nice is that the size is there. And this is something that we'll conclude on here in a second. But all smalls have a $100 multiplier, and all, as everybody knows, all options on stocks and ETFs have a 100 share multiplier. So when a small future is priced at around $20 and an ETF that has a high correlation is priced around $20, I can feel really comfortable in selling just one for one. I'm long one S30Y, I'm short one call in TBT. And you can see here, it's going to track pretty perfectly.
Wow. I never thought of it as being this simple. Honestly, when I was learning to trade futures at other exchanges and looking at the options on top of them, I was always confused with like the static versus dynamic delta and how do I equate these. So you're saying you can do this one for one. It's funny we're using TBT. It's like the inverse treasury bond, but it's actually the yield. Like they got to throw that inverse in there and confuse you. But if I am long S30Y and I sell like a 30 delta call on TBT, I'm just selling 30 deltas off my S30Y position.
That's exactly right. And so we're going to get into the hairiness here to end the show. But yeah, you bring up a great question. I want you to ask as many more questions as possible, Mikey, because I'm sure that they coincide with the viewership out there and what they're thinking and their hesitancy in the past with trading futures and options on a different product. The question always, the worst thing to me is always, I had a position, I'm long yields, I sold a call against it, and at some point, I was so right that I actually became over hedged and I started being wrong from that short call. What's great about the small is all that $100 multiplier. If you're trading shares or ETFs or what have you, as long as the price of that thing is at or below that small exchange futures price, then you can feel comfortable trading one for one the options on top of it. Now, if it's a piece that's extreme, that's like if you're trading, for instance, the pot stock futures, which is diversified 21 stocks, and then you go to one single stock that's a lot more volatile than that, yeah, you're going to get a problem there. But if you go from pot stocks to MJ, the diversified ETF that tracks almost as perfectly as this, then yeah, as long as the size is comparable, Mikey, you can go there and do the deltas however you usually do. And if yields move higher by a bunch, then at the end of the day, you'll just have zero deltas in your position because your in the money call will be at negative 100 deltas and your S30Y would be, like we say, that 100 deltas to the long side there. Now let's get into this hairiness, and Mikey, you can ask some more questions here. Now this is not perfect, but it's a way for you to think about things. And then as you get, like I can't right now create a scenario where like every trade, if someone's going to trade metals or they're going to trade stocks or interest rates, there's like one rule for how many options you do. But this is a good guideline to start off with. Like if they're the same price in the ETF or stock world, then yeah, I would go to 130 delta call, or if I'm short the smalls, I'd go to 130 delta put. Now, if that ETF is smaller and it's, half the size, then I would do 2 of those. If it's a quarter the size, then I could do 4 of them, and so on and so forth. Like this is what we do with SLV right now, is about a third the size of SPRE, which is our metals future. So I'm always doing, if I'm short SPRE, I'm doing 3 puts in SLV. Same if I'm long, I'll do 3 calls in SLV. Now, the extreme hairiness is when you're dealing with an ETF or stock, Mikey, that's larger. There, I'm almost always doing defined risk. Like you could go just farther out of the money, but if things really move higher and I'm long this future and I'm short a call in a bigger ETF, if things move way higher, then I'm going to be over hedged there. So I would do defined risk, or I would just go farther out of the money and really watch it and make sure my exposure hasn't turned over. But do those rules kind of jive with you?
Yes, that has cleared so much of the fog in my mind. And there's an important point I want to address here as well. And I think I'm addressing it correctly. So if I'm long one S30Y, that is essentially 100 deltas, right? And if I sell a 30 delta call on TBT, I'm taking 30 deltas off of there. Now, the difference is futures deltas are static, meaning S30Y moves up and down. I'm still long that one contract. I'm always going to be long 100 deltas. That option, that short call on TBT is going to change its delta. Sure. So you're saying it can grow, it could be a 50 delta if we're rallying there. It can fall back to a 10 delta if we're selling off a little bit. Yep. You use the option spreads on a larger pair because the deltas will stay relatively constant in a spread trade because they're adjusting at about the same rates. They're always going to be short or long those 10 or whatever the difference, the width between the two.
That's exactly right. So like, because this scenario there would be like, if things rip higher and I did like a $5 or $10 wide spread, then if things go $30 higher, you know, an extreme move there, I'm still locked in. It just, my hedge only took away $5 or $10 and I made, you know, $20 or $30 on the futures portion of it, and I didn't get over hedged on the short option piece. Yeah, this is really an underrated piece of small exchange products and something that is not, this is not usable for other exchanges, Mikey, because they have different multipliers. What's really nice, when you long or short a small exchange future, you are essentially just long or short 100 deltas in that market. That's as simple as that. It's the same as buying 100 shares of a stock or ETF, just different prices and a different product type. But we made it so that if you buy S30Y or you buy SM75 or what have you, just look at the price and be like, oh, I'm long 100 deltas of this thing. And so if I buy SM75, it's priced at $70. Okay, I'm long 100 deltas of stock at $70. And if I find, you know, an ETF that's $60, $70, $80, I can sell a call in that pretty comfortably and know that like I'm one for one pretty good. If there's an ETF that's 20 or $30, I can sell like 2 or 3 calls in there and be pretty good in there. It's really a simple, nice piece of the small exchange products that they do translate to essentially just 100 shares or 100 deltas of an ETF or stock.
That's a huge breath of fresh air for me because I think I remember trying to do this with like Euro FX and Sterling FX. And I know one of them 62,500, the other one's 125 for the underlying amount. And it's like, geez, so I got to cut my deltas in half here and they're cheap options anyway. Like, how do I structure this thing? Really cool to know. Thanks for sharing this with me. I actually learned quite a bit today.
Yeah, of course, man. This was a great idea by you. Pete Momat and I get so far afield with our future strategies that we forget about like stuff that isn't necessarily like simple or dumb by any means, but like this is really important and is really applicable to a lot of people. And we just kind of overlook it because I just do it in my head and then move on. But Mikey, thanks so much for joining me here on Friday, as you always do. Bring some great insight into the futures trading world. Hope a lot of people go look at these small exchange products and everything else. We are about to look at all futures products in a second here. If everybody hangs out, Splash into Futures Friday edition Losers Club coming up next. We'll see if we can find some new trade opportunities for the next week or dig ourselves out of some losers that we might have on the board here on Friday afternoon. Thanks everybody for watching. Peace.